IPO means initial public offering, but it also means it's probably overpriced.
In our recent video, we broke down Instacart's S1 filing, and since then, the stock has lost value almost every day.
In fact, there's been 23% fewer IPOs in 2023 compared to 2022, and most of them have tanked.
So what is up with the IPO markets, and are they as appealing as they once were for startups and growth stage companies?
Economic conditions aside, the past decade has introduced more alternatives to the traditional IPO for companies to raise capital.
So in this video, we are going to explain what IPOs are and their alternatives.
I'm not calling it a fraud because that's a technical term. I'm just saying that you've been fooled over and over again.
Why IPOs are struggling to deliver. VC investors, including Andreessen Horowitz, Sequoia, and Fidelity, invested at $125 a share, losing 77% of their value at IPO. Why business fundamentals trump price.
The price where the market trades a stock shouldn't matter as much as the fundamental value of the business.
And why you should avoid IPOs at all costs.
But if you insist on investing in IPOs, we have a few key insights to share with you to stack the deck in your favor, so stay tuned for that. Hi there, I'm Bertrand, and I'm the founder of App Economy Insights.
And I'm Stephanie, tech veteran, product builder, and creator. First off, what is an IPO? An initial public offering is a process of offering shares of a private corporation to the public in a new stock issuance for the first time. An IPO allows a company to raise equity capital from public investors. Companies use this capital to keep growing and expanding, using the money to invest in R&D, pay taxes on the equity they've given their employees, and pay off debt.
And this is particularly important for private investors. Think of startup founders, employees, or venture capitalists. They need to fully realize gains on their investment. Their private shares convert to public shares at the public trading price. The public trading price can be below the initial private investment. And that's how Instacart Series F investors faced losses at the IPO price. And more on this in a minute.
Meanwhile, it allows public investors to participate in the offering. So public investors like you and I get the chance to contribute capital to a company's shareholders' equity. But to IPO, a company has to meet requirements by exchanges and the SEC, Securities Exchange Commission, to hold an IPO. The company hires investment banks to market, gauge demand, and set the IPO price and date, and more.
So this is where the S1 filing comes in. Companies don't even attempt to IPO unless they reach a stage of maturity in which they can meet the rigors of SEC regulators.
Look, I don't know about you, but when I think about an IPO, I imagine that sparkling moment the executive team has ringing the bell at the NYSE or the NASDAQ, and it's like being at the helm of capitalism and the start of a company's continued growth and success. But lately, it's been losing some of that sheen, as IPOs have been followed by disappointing quarter after quarter. Uber's share price is pretty much at the same price since its IPO in 2019. 3 years after its IPO, Airbnb trades below its first trade. And for Snap Inc., they've lost almost 70% of share price since they went public in 2017.
Throughout the years, the number of IPOs has fluctuated based on economic factors. Tech IPOs were all the rage at the height of the dot-com boom, as startup, pre-revenue, rushed to list themselves on the market. In the late 90s, the stock market was soaring, with the technology-dominated Nasdaq index rising from under 1,000 to more than 5,000. The 2008 financial crisis resulted in a year with the least number of US IPOs, and after the following recession, IPOs ground to a halt and stayed that way for many years.
In 2021, we saw a huge spike in the US IPOs with 1,035 with a low interest rate environment. But since then, many of those companies have struggled to grow. In the US, the three most highly valued companies that went public in 2021 are Rivian, Coinbase, and Roblox. Each is down significantly from its IPO price. Of the companies that went public in 2021 and are still public, 45% are worth less than $500 million.
After that, the IPO market slowed down up to recently. In 2023, US IPOs have dropped significantly to 128 with the rising interest rates and tighter credit environment. financing is more challenging for companies to reach the critical size to IPO.
Okay, before we spill all the goods on why you should avoid IPOs, be sure to hit that subscribe button so we can keep bringing you content and help you on your tech, business, and investing journey. IPOs aren't the only way to go public. Companies looking to raise interest-free capital from the public can also do a direct listing instead of an IPO. Some companies don't want to issue new shares, which would dilute existing shareholders. And in addition, they might want to avoid lockup periods, which prevent employees from selling in the first 6 months after IPO. So they might choose the direct listing process, which is a less expensive option than an IPO. With direct listings, there are no new shares issued and there is no lockup period, in that insiders can sell shares of the company as soon as it lists, rather than wait up to 180 days to do so. So the downside? Without an intermediary, there is no safety net ensuring the shares sell. Spotify, Slack, and Coinbase have all gone public using a direct listing.
Yeah, as you can see, those are very famous names. That's why they could afford to go with a direct listing. Seems like a lot of upsides, like greater liquidity, allowing existing shareholders to sell shares directly to the public, and allows transparency with market-driven price discovery. And with a direct listing, the share price is determined by demand as opposed to an underwriter.
But what happens in a direct listing is insiders might dump their shares right away and you get this price volatility. It can cause shares to fall sharply. So IPO or direct listing, we can see price volatility with or without shareholder lockup periods. The underlying business and its earnings power is what determines its valuation. So the share price eventually catches up to reality.
And then came the rise of SPACs, or special purpose acquisition companies. They are formed to raise money through an IPO to buy another company. It's a way for a company to bypass the normal IPO process and SEC regulations by merging with another company. Investors in SPACs range from prominent private equity funds and celebrities to the general public. And SPACs have 2 years to complete an acquisition or they must return funds to investors.
SPACs have existed for decades, but their popularity has soared in recent years, which may have been triggered by the pandemic, as many companies chose to forego conventional IPOs because of market volatility and uncertainty, and also because of high-profile investors like Chamath Palihapitiya, aka the SPAC King, touting his SPACs online.
And the great thing is we found this company, and this is why we are really excited after months of diligence and work to announce a merger between IPOC and Clover Health to take Clover Health public.
Billion-dollar SPAC listings caught up with traditional IPOs in 2021 when there were 93 IPOs and 83 SPAC deals. SPACs again dominated in 2022, which in part reflects deal-making that was set up in 2021. And by H1 2023, there were only 4 SPACs.
As many as 70% of SPACs that had their IPO in 2021 were trading below their offer price by the end of that year. Truth Social, Trump's social media app, for example, went public via SPAC at around $100 per share and are now trading around $16. There is nothing wrong with companies going public via SPAC IPOs, to be clear, and many of them might turn out to be fantastic businesses. The issue is the level of froth that suggests, just like an operating company IPO, that some investors are willing to pay any price.
So what's happening to the IPO market with returns falling short for retail investors? Well, companies are waiting longer to go public. In the past, companies would go public and grow long past their IPO date. Public investors could reap the long-term benefits. If you invested $1,000 in Apple in its IPO in 1980, it would be worth like $1.8 million today. Today, companies wait, attract more fundraising rounds, and wait for valuations to rise. Since 2020, valuations have risen sharply, with the most US IPOs dominated by the tech industry. Today, there are 1,200 unicorns around the world, including decacorns valued at over $10 billion and hectacorns valued at over $100 billion, like ByteDance and SpaceX, neither of which have decided to go public.
Those that do go public are also issuing fewer shares with no real voting power. In 1980, the median float at IPO, that is, the percentage of the company offered to the public was 29% of the total shares. In 2022, that number was 15%, the lowest in 4 decades. Instacart offered only 8% of its total shares to the public when it IPO'd.
And yet, those who have gone public in the last 2 years have struggled to provide gains for their shareholders.
But a company's desire to get priced at higher valuation at IPO is proving to be a catch-22. Even after Instacart went from a $39 billion valuation to a $10 billion valuation at IPO, it struggled to maintain that value in the public market, dropping to $8 billion soon after going public. Tech stocks are still coming out humbled by the post-2021 IPO market slump. It's a much different environment than the IPO, SPAC, and meme stock frenzies in 2020 and 2021. Since then, companies have been contending with record high inflation, interest rate hikes, concern for the banking sector, and a volatile market. And this is a real test to the company's fundamentals.
And it isn't just bad news for retail investors, but private investors have taken massive losses with IPOs too. With Instacart's IPO, all private investors from the Series F round and onwards actually lost money. And those in the Series D and Series E rounds were not making any substantial gain. VC investors including Andreessen Horowitz, Sequoia, and Fidelity invested at $125 a share, losing 77% of their value at IPO. In fact, if you were to invest in the S&P 500 at the same time as the Series I in 2021, you would have been up 9% versus down 76%.
It's even worse for investors in the secondary market, where private company shares are actively traded before their IPOs. In the secondary market in 2021, Instacart's shares traded as high as $133 according to PitchBook. Likewise, those who invested in Snap in Series D and beyond have lost up to 73% of their value.
The past 12 to 18 months have begun complicating the VC business model and have brought into question the extent of unrealized losses on current fund performance. In many cases, VC investments past the Series C or the Series D round have not really yielded a worthwhile return, if any, in the recent years. Meanwhile, companies don't see IPOs as the golden goose that it used to be. Besides raising capital, the second motivation for an IPO is actually to create liquidity for early investors and employees. But public ownership is no longer the only way to create liquidity.
SpaceX and other mature startups have done regular private share sales without going public, allowing employees and existing investors to cash in on the rising value of their equity in the company. OpenAI is in talks to sell shares at a bonkers $90 billion valuation to private investors. And with platforms like EquityB, employees can exercise their stock options for cash.
Private investors and VCs are willing to keep funding these companies until two things happen. The company is strong but mature, and the returns from its growth phase are fully harvested. Looks like investors in SpaceX are still expecting long-term returns. Or two, the business model is suspect, and shareholders want to deploy a series of false signals to other fools to buy those shares so they can get their money back.
So what does this mean for you? It shows that power and wealth continue to remain concentrated in the private markets. If companies can get financed without going public and maintaining ownership, why wouldn't they?
For those that IPO, recent IPOs have signaled a massive change. Even late-stage investors are facing some tough conversations, and honestly, I'm sure they tried to convince Instacart not to IPO when they did. Companies like Instacart and Arm were looking for liquidity for early investors, founders, and employees.
And for Arm in particular, SoftBank was looking for liquidity. They took Arm private for $32 billion in 2016 and wanted to cash in on their returns. Lucky for them, they did. They achieved a $55 billion valuation in the 2023 IPO and retained a 91% stake in Arm.
As one of my favorites, Scott Galloway, has said, for the rest of us, IPOs are increasingly a way to transfer wealth from public investors to private. So let's summarize why you should avoid investing in IPOs.
Well, for one thing, the valuation of a company is largely driven by market conditions at that time. So it can be a rocky experience. Over the long term, the share price will correct itself to the business fundamentals of the company.
Second, Hype cycles and meme stocks over the last couple years have shown us that investors have skewed share prices based on emotion and FOMO.
Number 3, it might not be the best idea to buy IPO shares right when insiders are eager to sell theirs after the lockup period.
Like they said in the All In podcast,
The price where the market trades a stock shouldn't matter as much as the fundamental value of the business if you're willing to be a long-term holder, if you're willing to say,
And
you know
you're
what?
willing to do the work.
overall, I agree. Obviously, there are optimal and suboptimal entry points for buying a stock. Typically, stocks selling at higher PE ratios have higher growth expectations than those selling at lower PE ratios. But, again, you have to take a deeper look at the financials and competition to determine the growth prospect.
And while we don't give investment advice on this channel, we've said it before, IPOs are another word for it's probably overpriced. Instead of looking at share price alone, it's critical to do due diligence on the business fundamentals such as liquidity, cash efficiency, and resilience in this challenging market.
Now, if you still want to ignore everything we just told you, then fine, suit yourself. But here are 2 things to look for if you are going to invest in an IPO. First off, the smaller, the riskier. If we isolate the performance of IPOs based on last 12 months sales, 2 fundamental conclusions become readily apparent. The smaller the company, the riskier. Even the biggest IPOs, aka higher than $500 million in yearly sales, perform mostly only in line with the market.
Number 2, VC-backed is better. It's clear that companies that are already backed by VC money are performing better than those that aren't. Let's not forget that IPOs still underperform if you look at them on a market-adjusted basis.
If you want a deep dive on the Instacart IPO where we rip into the S1 and first look at its income statement and business strategy, then check out this next video.